Are you puzzled by the fact that gold didn't rally during the recent conflict in the Middle East? Because on the surface, it should have, right? Geopolitical tension rises, investors get nervous, safe havens are supposed to do well, and gold is usually one of the first assets people think about in that kind of environment, right? But this time, gold pulled back instead. So what happened? The answer is that gold didn't fail. The market simply cared more about something else. And there are three main reasons for that. The first one is real yields. The second is strength of the US dollar. And the third one is positioning, because gold had already done extremely well going into the year. Let's start with real yields. This is the most important part of the story. Most people assume that if inflation expectations rise, gold should rise as well. This sounds reasonable, but it is only half the question. What matters is what happens to nominal yields relative to those expectations. If nominal yields rise more than inflation expectations, then real yields rise, and that is what matters for gold. Real yields are simply the return you earn after adjusting for inflation. So if investors can suddenly get a higher inflation adjusted return from holding bonds, the opportunity cost of holding gold goes up, because gold doesn't yield anything. It doesn't pay any income. It doesn't generate any cash flow. Its value is largely tied to what people are willing to pay for it, especially in environments where money is losing value or real returns elsewhere are low. So when real yields are rising, gold starts to face the competition. This is the first reason. Now the second reason is the US dollar. When real yields rise in the US assets become more attractive relative to the rest of the world. This tends to pull capital into the US. And when capital flows into the US assets, the dollar usually strengthens. Now, why does that matter for gold? Because gold is priced in the US dollars, but it is bought globally, right? A European investor, for instance, not thinking in dollars, they are thinking in euros. A British investor is thinking in pound. So when the dollar strengthens, those investors need more of their own currency to buy the same ounce of gold. Nothing has changed about the gold itself, but the purchasing power of the buyer has changed, and this matters. At the margin, it reduces demand outside the US. So now you have two pressures hitting gold at the same time. Higher yields make gold less attractive relative to bonds, and a stronger US dollar makes gold more expensive for non-US buyers. This is already enough to explain a lot of the weakness in the recent past. But there is a third reason, and this is just as important: positioning. Gold didn't enter this period from a weak starting point, it's worth remembering. It entered after doing extremely well last year. It was up 64% in 2025. So by the time this conflict unfolded, gold was already carrying a lot of gains. And when an asset has already had a very strong run, it becomes more sensitive to shocks. At that point, it doesn't need a major reversal in the story. It just needs a catalyst. That catalyst, in this case, was the rise in real yields and a stronger US dollar. Once those two started moving against gold, some investors took profit, others reduced exposure. And because the market was already leaning in one direction, the move became larger than it otherwise might have been. This is often how markets work. They don't reverse because the long-term story has collapsed. They reverse because positioning was stretched and the immediate environment changes. Now there is another important point here. Gold and the US dollar can both rally during genuine stress periods. This does happen. When markets are dealing with an actual crisis, a proper liquidation event, a real scramble for safety, gold can rise and the dollar can rise as well. But this was not that kind of event. This was not a full-blown market crisis driven by panic. This was not a moment where investors were simply running for safety at any price. This was more of a macro repricing in my view. The market was not trading fear. It was trading inflation expectations, real yields, and what central banks might do next. This distinction matters enormously because if this had been a pure risk of panic, the reaction in the gold might have looked very different. Instead, the market looked through geopolitical headlines and focused on rates, and rates dominated. This is why gold softened. But that doesn't mean gold has failed. Far from it. Even after the recent decline, gold investors are still up more than 8% year to date as of 1st of April 2026. This matters because while gold has pulled back, it has done so from a position of strength. And while gold has been under pressure, equity markets have been struggling as well. So this is not a story of gold collapsing. I think it's a story of gold posing in an environment where rates temporarily became the more important driver. This is a very different thing. And it also means the story is not over. Because if real yields start to reverse, I wouldn't be surprised at all to see gold rally again. This is the key thing to watch from here. If real yields stop rising or begin to fall, then one of the main headwinds for gold starts to fade. And if the dollar also softens, that would ease a second pressure point. At that stage, the underlying support for gold could reassert itself quite quickly. So the right conclusion here is not that gold stopped being useful. It is that in this particular environment, something else mattered more. Real yields rose, the dollar strengthened, and the market was already heavily positioned after a very strong run. This combination was enough to trigger a pullback, but a pullback is not the same as failure, and in markets, this distinction matters. All the best.